If you keep most of your savings in cash or a traditional savings account, it's easy to assume that your money is safe. But over the long term, the real value of those savings depends on more than the number you see on your bank statement. It depends on how well that money holds its purchasing power. And the key idea behind this is the concept of scarcity, the degree to which something is limited. Now, scarcity plays a major role in determining why some assets preserve value over time, while others steadily lose it. And by understanding how scarcity affects different types of money, you can make more informed decisions about how you save, how you invest, and how to protect your wealth over time. And in this video, we'll take a look at three simple but important ideas. What scarcity really means for your money, a simple way to measure how scarce an asset is, and why some assets protect wealth better than others. And by the end of this video, hopefully you'll have a clearer perspective on how different types of money behave over time and how these factors influence the way wealth is preserved across different assets. To understand scarcity in a quantifiable manner, economists and investors often use the stock-to-flow ratio. It's a straightforward concept that helps measure how difficult it is to increase the supply of an asset and, in turn, how scarce that asset is. Here's how it works. Stock refers to the total amount of an asset that currently exists, the accumulated supply built up over time. Flow refers to the new supply produced or added each year. The stock-to-flow ratio is simply the total existing stock divided by the annual flow. In other words, it shows how difficult or easy it is to expand an asset supply. The higher the ratio, the more scarce the asset is, and vice versa. To make this clear, let's take a look at gold as an example. By the end of 2024, approximately 216,000 tons of gold had been mined throughout history, enough to fill roughly 2 Olympic-sized swimming pools. In 2025, miners are expected to add around 3,700 tons, which represents an annual increase of around 1.7%. Dividing the total stock of gold by the annual flow yields a stock-to-flow ratio of around 58. This means it would take roughly 58 years of mining at current rates to double the existing supply. This slow and predictable rate of supply growth, typically between 1 to 2% a year, is what makes gold a form of hard money, as it is inherently difficult to create more of it. And understanding this relationship helps clarify why scarcity matters. When the total stock of an asset increases significantly while demand remains constant, each unit generally represents a smaller share of the total supply, and its value tends to decline. This is why assets with slow, limited supply growth are better at preserving purchasing power over time. In this context, hard money refers to assets with a high stock-to-flow ratio, where scarcity is stable and supply growth is limited. Soft money, by contrast, has a low stock-to-flow ratio, reflecting a supply that can expand easily and a reduced ability to preserve value in the long run. Now that we understand what the stock-to-flow measures, let's compare how different assets perform under this framework, particularly those that investors often turn to for preserving their wealth. When we compare these assets, a clear pattern emerges. Precious metals, such as gold and silver, maintain high stock-to-flow ratios because their annual supply growth is slow and consistent. Their scarcity is naturally limited by the effort and cost involved in mining and refining, which helps them preserve value over long periods of time. In contrast, fiat currencies have much lower stock-to-flow ratios. Among the three most widely used fiat currencies, the US dollar has the most flexible supply. Its money supply has typically grown by about 6 to 8% per year, and it has increased much faster during crisis periods, reaching around 26% at the peak of the COVID-19 pandemic. Although fiat currencies differ in how quickly their supply grows, they all share one key feature. Their supply can be increased whenever policymakers deem it necessary. Central banks can expand their money supply rapidly, especially during a crisis or during periods of economic stimulus. While this flexibility could support short-term stability, it also reduces the currency's scarcity and gradually erodes its purchasing power. Bitcoin introduces a different dimension to the concept of scarcity. Unlike traditional assets, its supply is not determined by central authorities or physical constraints, but by code. New issuance of Bitcoins is reduced at regular intervals through an event known as the halving, which occurs roughly every 4 years. This predictable and declining supply schedule gives Bitcoin a stock-to-flow ratio already comparable to gold, and one that is programmed to only increase over time. Because of this structure, Bitcoin is often described as a form of digital hard money, a scarce, transparent, and verifiable asset designed to limit supply growth and resist inflation. Over the long term, Bitcoin's issuance continues to slow until the final supply limit of 21 million coins is reached, which is expected around the year 2140. After that point, no new Bitcoins will enter circulation. With the stock fixed and the flow effectively zero, Bitcoin would, in theory, become the most scarce monetary asset ever created, with its supply growth permanently capped. So, what does all of this mean for your personal finances? It means that keeping your savings purely in cash or in a traditional savings account is not an effective way to preserve long-term value. When your wealth is held in US dollars, its purchasing power tends to decline over time, roughly in line with the growth rate of the M2 money supply, historically averaging 6 to 8% per year. If you'd like to understand why countries, such as the US, continue to expand the M2 money supply and how that leads to currency debasement, check out my video on currency debasement explained. It provides helpful context for the trends we've discussed so far. So from a personal finance perspective, it may be sensible to keep part of your savings in hard assets rather than holding everything in cash or low-yield savings vehicles. Gold has served as this type of store of value for centuries, and that role continues to attract attention today. Even large financial institutions are paying attention to this shift. Morgan Stanley, for example, recently changed its model portfolio from the traditional 60-40 split between stocks and bonds to a 60-20-20 mix that includes gold as a permanent allocation. Yet the average US investor currently holds less than 1% of their portfolio in gold. In the short term, holding dollars can feel stable because the balance in your bank account gradually increases and inflation's effects aren't immediately noticeable. Meanwhile, assets like gold, silver, and Bitcoin often appear volatile as the prices fluctuate from day to day. Yet over the long run, these scarce assets have historically outperformed fiat currencies in maintaining real purchasing power. To illustrate this, let's examine how much gold and Bitcoin is required to purchase a median-priced home in the United States over time, compared with the cost in US dollars. This chart shows the median sales price for a new home in the US, beginning at $17,300 in January 1963 and rising to $413,500 in August 2025. This represents an increase of approximately 2,290% in the median US home price over the past 62 years in dollar terms. This shows that over time, more dollars are required to purchase the same goods. This second chart shows the same median home price over time, but adds a comparison in gold grams. The green line represents the price in US dollars, while the red line shows how much gold is needed to buy the same home. Over the long term, the gold-denominated price trend moves downward. This means that when measured in gold, a median-priced US home becomes less expensive over time. To put this into perspective, if you had purchased $17,300 worth of gold in 1963, you would have acquired roughly 15,300 grams of gold. Over most of the period between 1963 and 2025, the 15,300 grams of gold would have been enough to buy a medium-priced home. And by contrast, $17,300 in cash would only be able to afford your home in 1963, while its purchasing power steadily declined afterwards as home prices in dollar terms continue to rise. This comparison highlights how gold has preserved purchasing power over long periods, while the dollar has lost value as the supply has continued to expand. A similar pattern appears when home prices are measured in Bitcoin. Early in Bitcoin's existence, the median US home cost more than 3.6 million Bitcoins. Fast forward to November 2025, that figure had fallen to less than 4 Bitcoins. Although Bitcoin is significantly more volatile than gold in the short term, the long-term decline in the number of Bitcoins needed to buy the same home reflects Bitcoin's increasing scarcity and its ability to preserve or even increase purchasing power over extended periods. Taken together, these charts show a consistent pattern. Prices in fiat currencies rise over time. As the supply of dollars expand, the stock-to-flow ratios remain low, making the dollar a form of soft money that loses purchasing power steadily. On the other hand, prices in hard money terms fall over time. When measured in scarce assets like gold or Bitcoin, both of which have a high and rising stock-to-flow ratio, fewer units are needed to buy the same goods and services. These assets are therefore more effective at preserving purchasing power over long periods. This comparison shows how different types of money behave over time and highlights why understanding scarcity is so important when evaluating savings and long-term investment choices. Taken together, the stock-to-flow ratio offers a simple but powerful way to understand why different forms of money behave so differently over time. Assets with a high and stable level of scarcity, such as gold and Bitcoin, tend to retain purchasing power because their supply cannot be expanded easily. And in contrast, fiat currencies are designed to be flexible and expandable, which supports macroeconomic objectives but leads to a steady decline in real value over long periods. By comparing how many units of gold and Bitcoin are needed to purchase a typical US home versus the rising number of dollars required, we can see how these dynamics play out across decades. Understanding scarcity is therefore an essential part of making informed decisions about saving and investing, helping you consider not only where to allocate your money today, but also how to preserve its real value over time. If you're considering adding hard assets to your investment portfolio, it's useful to understand the factors driving the current gold rally in 2025. You can watch my full analysis here, where I break down the key drivers behind gold's recent rise and explore what may come next. If you found this video useful, please like and subscribe for more insights into economics, investing, and global markets. Thank you for watching and have a wonderful day.